Imagine placing a massive bet that the market is going to drop, setting your trading algorithms to cruise control, and then waking up to find out a sudden military operation just totally vaporize your position in seconds.
Right. I mean, that is essentially the brutal reality right now for hundreds of millions of dollars in short positions.
Welcome to this deep dive. Our mission today is to analytically deconstruct exactly why Bitcoin just violently shattered the $80,000 resistance level for the first time since, what, January 2026?
Yeah, January. It's been a minute.
Okay, let's unpack this.
Yeah.
Because looking at the price action, I mean, this wasn't just your organic everyday buying. It acted like a major microstructural event, like a coiled spring snapping under intense pressure.
Exactly.
But what actually created that extreme mechanical tension in the first place?
Well, the tension was built by traders heavily shorting the asset right below that $80,000 ceiling. They were, assuming historical resistance patterns would just hold.
Right.
But they were completely blindsided by a macroeconomic shockwave. When the price ticked up unexpectedly, it triggered this massive $356.55 million cross-exchange liquidation event.
Oh, wow. Wait, and a huge chunk of that was shorts, right?
Yeah, over $303 million of that was specifically short positions just getting completely wiped off the board.
I want to pause on that because understanding that cascading effect is super crucial. How exactly do execution algorithms turn a sudden price blip into a $300 million wipeout?
It comes down to pure mechanics. I mean, when you short, you borrow an asset to sell it, hoping to buy it back cheaper later. If the price goes up instead, your exchange demands more collateral.
And if you don't have it?
If you don't have it, the exchange's algorithm steps in and mechanically buys the asset at market price to cover your debt.
Which obviously drives the price up even higher.
Right, which then triggers the next trader's liquidation and so on. It's just a ruthless algorithmic domino effect.
And the trigger for this specific domino effect wasn't like a financial report. It was kinetic.
Yeah.
It was the U.S. launching Project Freedom.
Exactly. The U.S. deployed guided missile destroyers and 15,000 troops right into the Strait of Hormuz.
Just to escort commercial vessels.
Yeah. But almost immediately, you had Iranian informational warfare channels claiming a U.S. frigate was struck by 2 anti-ship missiles near Jaskport.
Even though ETPs totally denied it.
Right, they denied it, but the mere rumor was enough to spike Brent crude by 5.1% instantly.
So fiat energy markets panic because physical logistics are paralyzed. But I guess my question is, were undercapitalized short sellers essentially playing chicken with a global maritime crisis here and just getting mechanically liquidated?
Pretty much. What's fascinating here is how the asset is mechanically absorbing safe haven capital flight, away from fragile, energy-driven fiat stagflation.
We have this explosive geopolitical trigger on one side, but then looking at the institutional side, the foundation is like quietly hardening at the same time.
Oh, absolutely.
I mean, Morgan Stanley just launched their MSBT product, aggressively undercutting fees down to 0.14%. They pulled in $100 million in just 6 days.
Yeah, and the crucial detail in that Morgan Stanley data, 100% of that initial influx was self-directed retail capital.
Wait, really? No institutional money in that yet?
No, the massive pools of wealth managed by financial advisors are still locked behind internal compliance approvals. We haven't even seen the real wall of money hit.
And Goldman Sachs finally capitulated and filed for their own ETF.
Right.
But meanwhile, the physical network that actually secures all of this is going through a historic thermodynamic recalibration. We just saw the first Q1 hash rate drop since 2020.
Yeah, because hash price has just been crushed down to roughly $30 per petahash.
So mining just became incredibly unprofitable for anyone running older rigs.
Yeah.
So what does this all mean? If miners are shutting down obsolete hardware and pivoting like gigawatts of power towards $70 billion in AI compute contracts instead, doesn't that threaten the foundational security of the network?
It seems like it would, right. But if we connect this to the bigger picture, what you're actually looking at is a necessary thermodynamic cleansing.
A cleansing.
Yeah, the network naturally forces undercapitalized, inefficient operators off the grid. The Tier 1 miners left standing aren't just surviving, they are diversifying.
Oh, by repurposing their energy infrastructure for high-margin AI workloads.
Exactly. They transform from simple crypto miners into highly capitalized digital utilities. So the network security doesn't drop, it just consolidates into much stronger hands.
So for you listening, this really proves the asset has officially transitioned beyond just a speculative proxy. It's now a mandatory geopolitical hedge and a structural wealth baseline.
Regulated capital on-ramps and pristine collateral.
Which leaves you with one final thought to ponder. In a world where raw energy is simultaneously being choked by maritime warfare and aggressively consumed by the AI revolution, what happens to the ultimate value of a digital asset mathematically bound to global energy production?